is the coolest, probably the biggest thing in our industry. We've been stuck in a valuation box, you know, with low margins, a lot of capital, and susceptible to a lot of economic downturns.
Ford is going out of business. This might come as a shock to you, but if you have been following the car market closely, then you know that the company has been struggling for quite some time now. It didn't happen overnight. But what's more concerning is that with the downfall of this company comes lots of changes that will one way or another affect all of us. So how did we get here? What's happening? Ford, once a titan towering over the automotive industry, would suddenly go quiet, marking the end of a glorious chapter in American history. The iconic blue oval logo, a symbol of American ingenuity, innovation, and resilience, would fade into memory, leaving behind a legacy that once defined automobile manufacturing. Today, Ford isn't just a company, it's a cornerstone of the United States economy, employing roughly 186,000 individuals worldwide as of 2024, and making significant contributions to the country's gross domestic product through manufacturing and sales. But right now, Ford is facing a daunting financial reality that feels like navigating through stormy seas. But what are they gonna do about it? I mean, a company like Ford always has a plan, right? And how big of an issue are they facing? Well, just look at the statistics, because the numbers don't lie, and Ford is looking like it is in a crisis, a sea of red ink. When we talk about Ford's stock performance, it resembles a thrilling roller coaster ride, full of ups and downs that leave investors feeling a bit dizzy. Fast forward to 2024, and you'll find that Ford's stock has experienced notable volatility. Since 2016, share prices have wavered dramatically, ranging between $10 and $16. In 2019, the stock even hit a peak at around $16, but has since seen a troubling downward trend. To put this into perspective, Ford's stock has been lagging behind the S&P 500 index, which raises serious concerns among investors regarding the company's long-term viability. The drop in Ford's stock value can be traced back to several key factors that contribute to the current crisis. One major factor is investor sentiment. A recent earnings report dropped some disappointing news. Ford's non-GAAP net income for the second quarter of 2024 came in at $1.9 billion. But wait for it, this was a whopping 27% short of what everyone expected. Following this revelation, alarm bells sounded among investors, resulting in a staggering 18% plunge in the stock price immediately after the announcement. Market competition adds another layer of complexity to Ford's situation. The automotive landscape is bustling with both traditional car manufacturers and new players in the EV sector. Companies like Tesla have become formidable opponents, along with a wave of emerging Chinese automakers that are swiftly grabbing market share. These competitors are not just sitting back, they're rolling out innovative technologies and offering competitive pricing that directly challenges Ford's tried and true models, but none of these compare to the losses they faced on the EV market. Let's talk about it. The EV gamble. Ford's electric vehicle division is in hot water, and the financial losses being reported are nothing short of eye-watering. The Model E division, which is the brain behind Ford's EV strategies, is set to face projected losses that could skyrocket to $5.5 billion just in 2024. Let's break this down and explore the reasons behind these colossal losses. First up, we have high production costs. Making the switch to electric vehicles isn't just a flip of a switch. It demands a hefty investment in new technologies and fresh manufacturing processes. However, Ford's approach has relied heavily on older platforms for its EV lineup. This has resulted in higher per vehicle production costs when compared to rivals who have optimized their production systems for peak efficiency. While competitors are streamlining their operations, Ford finds itself playing catch-up, which certainly isn't ideal. Next on our list of troublemakers is the low sales volume. Despite Ford's grand ambitions to electrify its fleet, the company has faced significant hurdles when it comes to achieving substantial sales figures for its EV offerings. Take the electric F-150 Lightning for example. Initially, it was expected to fly off the lots, but the reality is that it hasn't quite hit the sales targets that were set. This shortfall has resulted in underutilized production capacities, piling on more financial pressure as the company strives to recover from these setbacks. Then there's the issue of strategic misalignment. Ford decided to phase out a large portion of its passenger cars, leaning heavily into trucks and SUVs instead. While this move might have seemed sensible at the time, it appears to have backfired. With consumer preferences shifting towards more affordable and fuel-efficient vehicles, Ford is now in a bit of a pickle. They're trying to pivot towards electric offerings, but it's proving challenging to maintain profitability while doing so. But that's not all. Ford also faces hefty warranty costs and expenses linked to recalls resulting from quality control problems. Recent recalls have impacted millions of vehicles, with a wide array of defects. Think safety issues with braking systems and glitches in electrical components. This situation creates a double whammy. Not only does Ford incur direct repair costs, but they also risk losing customer trust and shaking investor confidence. Financially, the impact is staggering, with estimates suggesting that warranty costs could soar to $1 billion annually because of these persistent issues. This kind of financial burden hampers Ford's ability to funnel money into new technological advancements or expand its existing product lineup efficiently. It's like running on a treadmill. You're putting in all the effort but not getting anywhere fast. Looking back at history, there are unsettling parallels to previous crises that Ford has weathered during economic downturns. Back then, similar quality control problems led to significant financial setbacks and tarnished the company's reputation. It makes you wonder, can Ford rise above these challenges once again, or are they stuck in a repeating cycle of difficulties? Well, it all comes down to their strategy. Let me explain. Strategic missteps. Let's talk about Ford's iconic F-150, a name that has become the backbone of American truck culture. It's no surprise that this model has consistently topped sales charts in its category. It's practically a household name. However, Ford's recent pricing strategy for the F-150 Lightning, which is the company's electric version of the beloved truck, isn't sitting well with a lot of folks. In 2024, Ford rolled out some hefty price hikes for the Lightning, with increases ranging from $2,000 to $10,000 compared to 2023 prices. Can you believe that the base model is now starting at around $54,995? This price tag comes at a time when people are increasingly feeling the pinch on their wallets due to rising inflation and economic pressures. Now, here's the kicker. The F-150 Lightning seems to be targeting a more affluent customer base, specifically with its premium models like the Platinum variant, which can soar to over $92,995. This pivot towards luxury can leave Ford's traditional customer base, those who lean towards affordability, feeling a bit alienated. Sure, the Lightning boasts some impressive features and technology, like a dual motor setup that delivers an eye-popping 580 horsepower alongside a towing capacity of up to 10,000 pounds. Yet many potential buyers who are searching for budget-friendly options find this price point to be just out of reach, especially given the current challenging economic climate. Ford's shift to high-end trucks has created a noticeable gap between what they offer and what their core customers really need. It's a tricky situation, especially with economic pressures on the rise. Just look at inflation rates hanging around 3.7% in 2024. Many consumers are taking a hard look at their purchasing power and trying to figure out how to make the best financial decisions. The average price tag for light-duty trucks has climbed to over $50,000, which certainly makes it tough for the everyday consumer to rationalize such spendy purchases. By focusing on luxury models and leaving out more affordable options, Ford is putting itself in a precarious position. This could allow competitors who offer lower-priced alternatives to swoop in and capture market share. Brands like Ram and Chevrolet are already rolling out competitive models with similar features that come with friendlier price tags. We're also seeing a rising interest in mid-range trucks as consumers lean towards vehicles that manage to strike that balance between capability and cost-effectiveness. It's a clear indication that consumers are looking for more bang for their buck. When it comes to the electric vehicle scene, things are shifting rapidly, and it's particularly notable with the emergence of lower-cost options from brands such as BYD and Rivian. BYD's electric models are really making a name for themselves because they hit the sweet spot of affordability and performance. That's right, many of their models start below $40,000, so it's no wonder that budget-savvy shoppers are giving them serious consideration. In the first quarter of 2024 alone, BYD reported mind-boggling sales increases of over 200%, positioning themselves as a major contender in the EV market. Ford's pricing strategy for the F-150 Lightning seems a bit tone-deaf in the face of this rising competition, with cheaper EVs creeping into the marketplace and capturing consumer interest like never before. Ford's high sticker price may hamper its ability to stay competitive. As consumers grow increasingly discerning about the value they're getting in their vehicle purchases, Ford needs to tread carefully through this challenge. Otherwise, they might risk becoming irrelevant in an automotive market that is bursting at the seams with options. And in a move that that has stirred its fair share of controversy, Ford announced it would be phasing out nearly all of its sedan offerings in North America, except for the Mustang, of course. This decision stemmed from an analysis that suggested SUVs and trucks yield higher profit margins than their sedan counterparts. But let's just say it represents a significant strategic miscalculation. By turning their back on sedans, vehicles known to be popular among first-time buyers and those in search of fuel efficiency, Ford is essentially closing the door on a hefty segment of potential customers. The halt in production for sedans might have disregarded the growing demand for affordable and fuel-efficient vehicles, especially as gas prices went on a roller coaster ride and environmental concerns gained traction. In 2023, sales of compact cars saw a notable surge of 15%, signaling that there's still a vibrant market for smaller vehicles out there. By failing to tailor its offerings to meet these evolving consumer preferences, Ford risks pushing away loyal customers who might feel overlooked by the brand's current focus on larger vehicles. Ford's choice to cut sedans from its lineup doesn't just reflect a short-sighted view of where the market is headed, it's also a missed opportunity in a rapidly changing automotive landscape. With the market shifting more towards smaller cars, driven by rising fuel costs and urbanization trends where compact cars are usually more practical, Ford's gaping absence in this segment makes them vulnerable to competitors who are stepping in to meet these customer needs. Moreover, this strategic blunder stands in stark contrast to the soaring sales numbers reported by competitors who continue to invest in smaller vehicles. Just look at how well Toyota's Corolla and Honda's Civic are holding their ground even as passenger car sales experience an overall decline across the industry. By not offering alternatives in this crucial space, Ford risks losing current customers and potentially missing out on future generations who may lean towards smaller vehicles as their main mode of transportation. But what are the implications that come with this loss? Let's break it down. Dealership network. Ford's financial turbulence is sending shockwaves through its dealership network all across the United States. With sales dwindling and financial pressures escalating, many dealerships are caught in a tough spot, leading to closures or a significant drop in operations. What does this mean for the dealerships and the communities they serve? Well, it's becoming increasingly common to hear about dealerships shutting their doors due to a combination of dropping sales figures and rising operational costs. A telling example is Patriot Ford, located in a small town that relies heavily on Ford sales. Recently, this dealership announced its closure, highlighting the larger economic issues at play. The fallout from such closures isn't just a number, it reflects the struggles of a well-known brand and the people who depend on it. Now, let's consider the job losses that accompany these closures. Each dealership like Patriot Ford isn't just a place to buy cars, it's a source of livelihood for dozens or even hundreds of employees. When a dealership closes its doors, it sends a ripple effect through the community. Lost jobs mean less income for families, which puts even greater financial strain on local economies that depend on automotive sales for their survival. Taking a closer look at the situation with Patriot Ford brings this impact into sharper focus. That dealership isn't just another storefront, it stands as a testament to local pride and tradition. For many residents, the ties to Patriot Ford run deep, often passed down through generations, making it much more than just a place to buy a vehicle. It acts as a gathering spot, fostering a sense of belonging among community members that goes beyond car sales. It's about shared memories, family connections, and a collective history. Now, if this dealer were to close its doors, we're talking about a serious ripple effect. Right now, industry reports suggest that around 10 to 15% of Ford dealerships across the US are facing challenges, with roughly 300 to 450 dealerships potentially at risk of going under. This isn't just statistics, it represents the heartbreaking end of local traditions tied to Ford's legacy as a beloved American car maker. Imagine the loss of family stories centered around first cars and community events held in the dealership's parking lot. The community impact of losing a dealership like Patriot Ford is profound. This establishment often plays a significant role in shaping local identity and pride. Dealerships frequently engage with their communities through sponsorships, charitable contributions, and local events. The loss of such a long-standing business diminishes not only the commercial landscape, but also the support network that dealerships provide, which can include funding school sports teams or contributing to local charities. Let's dive into the hard-hitting truth of what happens when a dealership shuts down. Each dealership typically employs a multitude of people, from enthusiastic salespeople to skilled service technicians. If Patriot Ford were to close, it could lead to 50 to 100 people suddenly losing their jobs. That kind of loss impacts families directly. Think of parents worrying about making ends meet, kids facing uncertainty, and the overall financial strain that can ripple through every household in that town. It's crucial to understand the automotive industry isn't an isolated bubble. It's interconnected with the entire local economy. A dealership is an economic hub that supports various local businesses like restaurants, grocery stores, and service providers. When jobs vanish at one of these dealerships, it's not just a couple of job losses. A study by the National Automotive Dealers Association highlights that for every dealership job lost, around 2 to 3 additional jobs could disappear in the local community due to decreased spending power. This domino effect can send shockwaves through the economic landscape, leading to higher unemployment rates, less consumer spending, and further economic downturns. And let's not forget about the rural towns that already struggle with job diversity. The recent news about Ford cutting thousands of jobs globally, like the 3,500 layoffs at the Saarlouis plant in Germany, isn't just a distant problem. It signals a looming reality for US markets as well. Closing dealerships could intensify these vulnerabilities, pushing communities to the brink. And let's not forget about the rural towns that already struggle with job diversity. The recent news about Ford cutting thousands of jobs globally, like the 3,500 layoffs at the Saarlouis plant in Germany, isn't just a distant problem. It signals a looming reality for US markets as well. Closing dealerships could intensify these vulnerabilities, pushing communities to the brink, but the impacts stretch beyond economics. There's a social cost that's equally important. Think of the role dealerships play in sponsorships for local sports teams or community events. Patriot Ford might organize fundraisers and contribute to food drives during the holidays, bringing people together for a good cause. When such dealerships close down, the gap left behind in community support can be profound. Without the financial contributions from these businesses, local charities that depend on that backing may struggle to function. Many of these nonprofits, particularly in smaller towns, operate with shoestring budgets and rely heavily on local patronage to keep their doors open. So losing that support can jeopardize essential services that help people in need. Moreover, let's talk about the emotional aspect. Local dealerships often serve as informal gathering spots, where community members bond over their passion for cars, share stories, or even rally for charity events. Without these spaces, the fabric of community connection begins to fray, leading to decreased engagement and weakened social ties between residents. Can Ford be saved? Ford Motor Company is currently at a critical juncture in its journey, looking to redefine its approach amidst major challenges in the automotive industry. They've recently outlined a strategic shift towards hybrids, commercial vehicles, and potentially more budget-friendly electric vehicles in an effort to revitalize both their brand image and financial standing. So, what's the scoop? Let's dive in together. At the heart of Ford's revamped electrification strategy is a response to shifting market dynamics and changing consumer preferences. Ford has realized that the American electric vehicle market isn't growing as quickly as they expected. Because of this, they've decided to shift their focus from only pursuing an all-electric lineup to embracing hybrid models and affordable options. Let's break down what this strategic pivot entails. First up, Ford is placing a strong emphasis on hybrids. They plan to enhance their hybrid offerings by leveraging existing technology and infrastructure. This move is particularly timely, as sales of gas-electric hybrids surged by an impressive 35.3% in the first half of 2024, outpacing electric vehicle sales in the US. This trend signals a growing preference for vehicles that strike a balance between fuel efficiency and traditional gasoline engines, making hybrids an attractive choice for budget-conscious buyers. Next, let's talk about commercial vehicles. Ford has exciting plans to introduce a brand new electric commercial van in 2026, which will be produced at their Ohio assembly plant. This step aligns perfectly with Ford's long-standing history in the commercial vehicle sector and targets a market segment that is increasingly leaning towards electrification. By focusing on commercial applications, Ford can enter a space where businesses are actively seeking cost-effective solutions for their fleet operations. Affordability is also a major theme in Ford's strategy, with consumers becoming more conscious about their budgets. Ford plans to roll out lower-priced models with longer ranges. This is essential, especially considering that many potential EV buyers have expressed concerns over the high upfront costs and range anxiety typical of electric vehicles. Ford's CEO, Jim Farley, emphasized the point beautifully when he stated that an affordable electric vehicle starts with an affordable battery, underscoring the need for competitive pricing in the EV landscape. However, this journey won't be without its bumps along the way. Ford anticipates facing substantial financial challenges due to this strategic shift, which includes a hefty $400 million write-off for manufacturing equipment linked to previously planned all-electric SUVs that are now off the table. Overall, the costs tied to this transition could surpass $1.5 billion, highlighting the financial strain of adjusting production capabilities and market focus. Is this strategy enough to turn the tide? The success of Ford's new approach relies heavily on several crucial factors. Production costs remain a significant hurdle for the company as it strives to compete with rivals like Tesla and emerging players, including Chinese manufacturers such as BYD. Recent reports suggest that Ford's EV division may lose around $5 billion in 2024, with losses nearing $44,000 for each electric vehicle sold during the second quarter of that year. To mitigate these losses, it's crucial for Ford to streamline operations, enhance manufacturing efficiencies, and reduce reliance on expensive battery technologies. Next, let's consider market demand. As consumer preferences shift, the rising interest in hybrid vehicles, offering both efficiency and convenience, opens up a promising avenue for Ford. By aligning its offerings with these market trends, Ford could position itself advantageously compared to competitors heavily invested in purely electric models. Technological advancements will also play a pivotal role in the success of Ford's strategy. The company is planning to improve its battery procurement processes and invest in local production capabilities, which is essential to qualify for tax incentives under the Inflation Reduction Act. Such strategic investments aim to lower costs and bolster profitability across its EV lineup. And for any turnaround strategy to succeed, rebuilding trust with both dealerships and consumers is absolutely critical. Many Ford dealerships have felt the effects of recent strategic shifts, leading to closures and decreased sales. To regain that trust, it's essential for Ford to equip dealerships with competitive products that meet consumer needs, while providing ample support during times of transition. When it comes to consumer confidence, transparency is key. As customers become more selective about their vehicle choices, Ford must be open about product offerings and pricing strategies. Engaging campaigns that focus on affordability and reliability can significantly aid in restoring faith in the brand. The stakes are high, as potential closure or setbacks for Ford could reverberate throughout the entire American automotive industry. If Ford were to stumble significantly, it could create a ripple effect that opens doors for foreign automakers, particularly those from China, who are rapidly expanding their foothold in the US market. For example, in July 2024, sales of new energy vehicles in China accounted for over 51% of total market sales, exemplifying the competitive pressure facing American manufacturers like Ford. Moreover, the urgency for innovation will only grow as automakers strive to keep up with ever-changing consumer demands and groundbreaking technological advancements. Companies will need to adapt swiftly to maintain relevance in an environment that's rapidly pivoting towards electrification and sustainability. While Ford is undoubtedly facing a mountain of challenges ahead, their strategic shift towards hybrids and commercial vehicles could well be a path to recovery if they execute it thoughtfully. By prioritizing affordability, restoring trust within their dealership network, and proactively responding to market demands, Ford stands a chance to navigate these turbulent waters and potentially emerge stronger in the constantly evolving automotive landscape. The question now is, can they rise to the occasion? Let's know your thoughts on the comments below. Thanks for watching, and I will see you on the next video.